Welcome back. You're watching the ET Money Show with me, Kavita Thapliyal. Now, there are plethora of funds available in the market to invest your hard-earned money, but how do you assess which is the right fund for your portfolio? What are the criteria that one should look at? To help you navigate through this maze, we have on board Feroze Aziz, Deputy CEO, Anand Rathi Private Wealth. Feroze, good evening. Welcome to the show. And we'll be starting off with our viewer queries. But before that, to all the viewers, do not forget to send us your portfolio queries on our WhatsApp number, which is 865-797-4571. You can also email us your queries on themoneyshow@etnow.tv. All right, so let's begin, and we have our first viewer on phone, Mr. T.K. Venkatesan from Chennai. Hi, good evening. How are you doing, sir?
Oh, good evening. How are you? I'm fine. Thank you.
Thank you so much for sending us your query. We have Feroze Aziz who will be helping you out today. I know you have sent us a query, but then do you mind talking about your portfolio and the kind of question you have to ask Feroze today?
Yeah, maybe I can do that. Yeah, sure. I can do that. Mr. Feroze, thank you for the opportunity. See, I do have a PMS equity investment through PMS, or Portfolio Management Service, and I do manage my own direct management of equities as well.
Okay.
In both of them, I am to say that I do have profit to be booked or whatever. But I'm only an investor, not really a trader to be booking profit every day or so.
Okay.
But conventionally speaking, you take, the advice is always to take out the profit when you domestically need it or when you need it urgently and things like that.
Sure.
Whereas I wanted to understand now, because of the volatility which is there, I see erosion every day, one way or the other, Because of the volatility, there is a bit of uncertainty. There is a feeling that creeps in that, probably I should redeem some profit and cash it somewhere in FD or elsewhere safely. So I just wanted advice on the philosophy of profit booking in the current state of affairs of volatility, uncertainty, or the market in the current way the market is and things like that.
Sure. All right. So one thing is very clear that there is no immediate requirement, right, from the portfolio that you have made so far, from the profits that you've earned.
That's right. Despite no requirement for me, but the volatility and the uncertainty makes me feel that it's better to take off some and kind of safeguard it or something like that. Otherwise, I see this a bit of erosion slowly over a period of time happening.
No, we can really understand, because it's not only your story, it's like the worry of every investor who is seeing their money being eroded and the profit just vanishing from the portfolio. So Feroze, how does one actually redeem and withdraw from the equity exposure that they have and the profit also that they've earned from? How to secure your profit? That's a major question.
Yes, Kavita, and I think Venkatesh Saab has a very pertinent, it's a classic dilemma, right? When your portfolio has done profits and you've not taken it, every day little market drifting downwards starts becoming a very painful process to see it erode, having had made the money. So how we look at it at Anand Rathi Wealth is, there are some instruments which oscillate more. For example, PMS's standard deviation, which is a risk measure of volatility. Sir mentioned volatility a few times in his question. So volatility is a measurable number. So if you are going to be measuring volatility for your respective PMS, it is quite likely that the PMS has a volatility greater than a corresponding equity mutual fund. So what we do is, we basically look at instruments which have lower volatility. For example, the 11 mutual fund model portfolio, a 3-year standard deviation is 12.3 for our 11 schemes. But you have PMSs with 20 standard deviation. So whenever there is immense profit, when the oscillation happens on the positive side, remove it and don't get into a bank account, get into lower risk equity. All equity might be called equity, but they're not same at risk. Stocks can have 70% standard deviation. A PMS can even have 28-29% standard deviation. A mutual fund generally operates between 11 to 14 standard deviation. So when you have to reduce volatility, the only answer is to not move from equity to a bank account or an FD. You can reduce the exposure to higher risk equity. That's one method, philosophically speaking, because that was the point of the question. Second, to my mind, booking profits on the virtue of rebalancing is a great idea. If you had a 50-50 asset allocation, it always happens that equities move very sharply. If they have moved very significantly upwards and they've gone to 60%, be very disciplined to bring it back to 50 by selling equity and buying debt. So in sharp moves upwards or downwards, rebalancing the asset allocation to the desired 50-50 in this example is going to be a very good way of skimming the malai, as we call, in the equity assets.
All right, Mr. Venkatesan, any other question from Feroz? Are you clear with your point?
Yeah, that's fine. Thanks so much on that. And I mean, he was, I think, Mr. Feroz, you talked about the whole portfolio management in the sense of equity, debt, and any other asset classes. Okay, I was just talking within the equity itself. So I understand your response, and I think I should see the overall picture and then try to balance between equity and debt. And that's the way to skim out the profits when you do not have a specific need.
Thank you so much,
right?
sir. Thank you so much. Thank you so much for sending us your query.
I'd like to add one thing on Venkatesan, sir.
Sure. Yeah.
Is please, if you don't know the volatility of the PMS, speak to your provider and find out the volatility number. That will bring in immense clarity. Because if that's what you're worried about, then you have to measure it. If I'm worried about my weight, I'm going to measure my weight to start with. Similarly, if that's a worry, measure it or ask your provider to give you that volatility number.
Right. A bit of clarity is needed over there. Thank you so much. And we move on to Mr. K. Nagi Reddy's question from Hyderabad. He's on the phone line with us. Mr. Reddy, hi, good evening. How are you doing?
Thank you, madam. I am retired employee, madam.
Okay, sir. And I see you are investing in Franklin India Blue Chip Growth Fund, Franklin India Smaller Companies Growth, and Tata Small Cap also.
Yes, madam.
Since last 5 years. And so the investment that you're making is just for a specific...
No, madam. I am holding 10 years. Next 10 years also.
Okay.
I am started 10 years back, madam, SIP. 3,000 starting per month.
Okay, and you want to continue for more 5 years?
Yes, madam. Another 5 years.
More 5 years. Okay. So what's the corpus that you are looking at and how much have you accumulated? Any idea?
Madam, monthly expenditure around 30,000, madam.
So you want that 30,000 from this investment?
Yes, madam.
Okay.
Already my corpus around 15 lakhs.
15 lakhs already?
Already accumulated mutual fund NAV, madam.
Okay. And is there any other earning or portfolio details that we can get, your investment details, or this is the only investment you're dependent on for your regular income?
This is regular income is senior citizen savings scheme one is there, madam. There is no other regular income.
All right. And you need 30,000 per month. Feroz, any other question you want to ask to get more clarity?
I think Mr. Reddy's question is reasonably clear.
Okay.
I think first thing is, if 30,000 is your expense, Mr. Reddy, it must be an expense of today. Right? Not at retirement. Let's assume you have kept yourself 5 more years to accumulate wealth and then consume it as the question goes. So try and provision for a 40-45,000 rupees monthly expenditure, because that's the kind of Mengai inflation which is going to catch up with your money and your expenses. Point 1. Point 2, the good news is you have 15 lakhs already. You're continuing your SIP for the next 5 years. So in 5 years, if this money were to grow at 15%, your 15 lakhs will first become 30 lakhs. If 15% was the return, I'm just assuming it that way for simpler mathematics. And whatever you're going to be incrementally investing for the next 5 years can give you another 20-30 lakhs. So if you want to have a regular income from a certain corpus, you should not expect more than 0.5% per month. By which I mean, if you have 50 lakh rupee corpus at the end of 5 years, 15 growing to 30 plus your SIP amounts taking you to 50 lakhs hopefully in the next 5 years, you can expect only 25,000 per month. So it's important to not provision for more than a 6% consumption per year if you don't want to touch your capital. If you want to consume your capital in the subsequent 15 years, you can almost withdraw 9% of your current that corpus in the form of STP. So 6% or 9%. So I personally think if you keep doing your equity investments, you should be ending up with 40-50 lakh kind of a corpus at the end of 5 years, which should give you 25,000 rupees recurring income per month.
All right, Mr. Reddy, is there anything else you want to ask?
Madam, still I continue these schemes or I will shift to another schemes?
Feroz?
Yes, so I would suggest that
I'm continue these three schemes is good.
See, I would suggest, Mr. Reddy, to not do your small cap investment in the Tata Small Cap Fund. You have two Franklin funds and one Tata fund. I personally think small cap is a riskier strategy. So sticking to the large asset management companies is a better idea. For example, the largest small cap fund is HDFC Small Cap Fund, right? That is a good 12-13,000 crore kind of a fund. That's going to be more stable. Chirag Setalvad is the fund manager. So I would, if I were you, I would firstly not have two small cap funds and at least not have the Tata Small Cap. And Franklin, I'm sure is a great fund house with great processes, but two schemes from one fund house, not needed. You can continue your current corpus, but I think for your further investments, you should look at diversifying into other asset management companies. Let's say looking at SBI might make so much more sense. SBI large and mid cap and SBI Contra are great two schemes from the largest asset management company, which is SBI Mutual.
All right. Thank you so much, Mr. Reddy, for sending us your query, and all the best with your investments. Next question is from Dhaval, and he's planning to invest 30,000 per month. His target is 10 crores in 15 to 17 years, and he wants to know if any change is needed in the current portfolio. And the kind of funds he has in the portfolio are IIFL Focused Equity, PGIM India Flexi Cap, Kotak Emerging Equity, Axis Growth Opportunity. Feroz.
Yes, so I think Dhaval, firstly for your investments, I personally think you have a very ambitious target of 10 crores and 17 years. That's going to be very difficult with a 30,000 amount, because if you work backwards and even assume a 14% return, which is 11-12% coming from Nifty, which is the median return of Nifty, and 1-3% coming from the active management the fund managers are going to deliver, hopefully. So then also at 14% assumption, you will still need a 1,20,000 SIP amount. So of course it's easier said than done, because if you're going to be starting with 30,000, it's not going to be easy to scale it up to 1,20,000, but gradually try and scale up. If you extend your time frame by 5 years, then this becomes very simple. And with a step up of 10% and an extension of 5 years, you will be able to meet your 10 crore goal. That's point one. Coming to your schemes, I would, if I were you, I would not look at a focused fund from IIFL Equity, Focused Equity, because Focused is anyways a concentrated high conviction platform or a fund category. So I would look at a larger fund house like an ICICI Focused Equity, which I think the category is great. But if I'm going to go high risk, I'm going to go with very large names, be it in the small cap or the focus. That's the one suggestion I have. And then you can also look at Axis Growth Opportunities Fund, which I think you should exit. That has been your worst performing scheme out of your 4 schemes over the last 1 year. And I think HDFC Focus 30 is also a great fund. ICICI Pru Large and Mid Cap, ABSL Multi Cap, and HDFC Small Cap and SBI Contra would be great schemes for your inclusion for your 30,000 rupees, because 30,000 will need 7-8 schemes at least.
All right, and with that, thank you so much for joining in today and helping our viewers with their financial portfolio, Feroz. And before I wind up the show, I would like to leave our viewers with a WhatsApp number and an email ID where they can send us their portfolio details and have their portfolio questions answered by our expert. That's the WhatsApp number and email ID where you can directly get in touch with us. Thank you so much for watching. Goodbye.